Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Cramer, and today we're going to do another episode of Cramer versus Cramer. This will be episode 2. Everyone liked last week, or almost everyone did. So we're going to try to make this a weekly thing, or at least a regular thing, where I go through some of Jim Cramer from Mad Money's lightning round questions, and then I give you my quick take on both the stocks that are asked about and his take on those. It looks like we have 13 that I'm going to run through this week, and this is recorded on May 16th. These all came earlier in the same week this time. Okay, so let's get started. ASML was the first question, or the first stock that I'm going to look at. Jim said no on ASML. He liked Lam Research better. I'm going to have to disagree with him on this one. So I barely missed buying this one on the recent dip here, on the tariff dip. And so it's pretty close to my buy price, about 25% away. I think I do have a video on this one out if you want to go see what that buy price actually is. But Lam Research is about 60% away from my buy price. So on a valuation basis, there's nothing wrong with Lam Research. If it got to my price, I would buy it. But I think the odds that ASML gets there first, and then the closer, it's just closer. So I think the potential returns are going to be better for it over the medium term, even though I haven't bought it yet because I barely missed it. Okay, next one is O'Reilly Automotive. So the caller was asking about, I guess there's a stock split coming. Oh, it looks like it's going to happen on June 10th, 15-1. So, the nominal price here is over $1,300 a share. I'm not a huge fan of like stock splits necessarily, but when it gets up that high, if you're in some accounts don't have fractional shares, and if you're buying this for, like I think I bought mine maybe for my daughter or my son's account. I don't own O'Reilly, but I own AutoZone, which is very similar, and it's even more expensive. So it can get a little bit expensive if you're buying it for a small account. So I think the stock split means absolutely nothing in this case. Jim liked AutoZone better, which I own AutoZone. So let's look at that one. Now, I don't think either one of these are a buy right now, but you can see like it gets a little crazier. If you're buying in a smaller account, to have to pay $3,000 or $4,000 a share, like that's a substantial amount of money. If you're trying to run a diversified portfolio. Fortunately, I bought this one back at the bottom here. It's up like of 2020, and it's up like over 400% now, which is nice. But it's not a buy right now. So, it's trading at a 25 PE. This year, earnings growth fell to 3%. Could do okay in the next couple years. I actually think this is probably going to moderate and come down at some point, which is unfortunate if it does happen for me, since it's one of my, other than Berkshire, I think it's my largest holding. But I'm buy and hold on that one for now. But I don't think it's any better than O'Reilly. I almost bought O'Reilly at the exact same time. O'Reilly barely missed my buy price in March 2020. AutoZone hit. So that's the only reason I own one over the other. It was just that close. Okay, next one. Healthcare REIT. This one used to be really popular back in the day. Around the peak, of course, 2015. This was just a huge dividend growth. Investors absolutely love this one. I'll just pick a date here. Returns have been barely above inflation since then. Jim didn't like this one. He liked Ventas instead. I don't like it either, by the way. At least not right now. He liked Ventas instead. I don't like very many REITs right now, and I don't think Ventas is a buy either, but it is way better, I think. It's one of the few REITs you can see how it's performing here. It might be, I think, gotten a little ahead of itself, but it looks better than 99% of REITs, even though I don't think it's quite a buy yet. So I think, if you're going to share an idea, it's not a bad one. in the REIT world. So I halfway agree with Jim, I guess. Astera Labs is another one. Jim liked this one. He thought it was a buy. So at first I was like, well, so this is all we have in terms of data. It's only a year and a half public, it looks like, and maybe less than that. And at first I was looking at it. I didn't like know what they did. I was like, labs, okay, who knows? That could be a lot of things. Earnings growth is expected to be pretty good. So this could be one of those companies. It's like a decent, like early stage growth opportunity. If you give it like another year, that was my initial thought. But then I looked down and saw they were in semiconductor industry and they're already worth 15 billion, and no. So it's probably going to be cyclical. Almost all semiconductor businesses are cyclical, and that means that all this earnings growth projection might not, it could be okay, but it could be a total disaster. It could fall like 80 or 90% too. And I don't think anybody can predict that quite yet. I certainly can't. So to me, this is just, wait and see, get more data. And it's not even like particularly small value, like small business. So, and don't use valuation for those. Well, you could, it's 89. So it's not even cheap on a cyclical basis, but the danger there is pretty high, I think. So avoid for me for now until there's more data. Learn, Stride, or LRN. Online, it sounded like it was like an online learning tutorial business. So this one's pretty interesting. It's had these phases with huge growth and then a decline and then huge fast growth and then a decline and then huge fast growth and then a decline. And then it looks like COVID gave a real huge boost to them. So what I would have said 2 years ago was, well, this is probably some kind of a boom bust. These earnings are probably going to fall. And so it would have been an avoid for me, but they've done the exact opposite. They've grown like 100% in the past couple of years. And Jim didn't know about it. He's like, I need to do more work on it. I would say this one's probably it's probably overvalued right now. It looks like earnings growth is expected to slow down, or fairly valued. I guess it's only a 20 PE. But you would want to do more detailed work on the business and find out what's really driving these past 2 years specifically of growth. If that's something that's like a secular growth potential trend, then maybe you can get a pullback if earnings growth slows down, and maybe this could be more interesting. I'd probably put it in the too hard category, but I wouldn't necessarily, since they've had such a good 2 years even after the COVID boom, that could be a longer growth trend. So there could be something there, but it would require, deeper work for sure. ADT, Jim didn't know about this one. He couldn't make his mind up. He said he used to be bearish. What are we at? Okay, so the thing is, earnings growth is sporadic. We don't have a long history. And it looks like the total enterprise value is double the market cap, so there's a lot of debt. So that 10 PE is probably really more like a 10 or 11. PE is more like a 20, 22 PE, which is like where the market's at. So it's probably valued the same as the rest of the market. It's just not very interesting to me. No, can't read my own handwriting. DVN. Okay, so I had a video out on this one back, I think it was in this dip right here, 2024. Yeah, it was the beginning of I bought it in around January. I might have made the video a couple months later or around that time. So for me, so this is oil exploration, like fracking and so forth. For me, and we can widen this up a little bit too, so you can see the bigger picture here. This was more of a portfolio balance type of a thing, because I bought this and Oxy because I didn't have any oil exposure, and the prices had come down on these to where if there was an oil energy price spike, which I wasn't necessarily predicting, but it was potentially there. I wanted this portfolio balance, and we actually did get a bit of it that happened. Right here, right? This jump kind of up here when energy prices spiked a little bit. And you could see that where it was up like 30% in a month or something like that, where that really did help balance out the portfolio a little bit. But even in that video, I pointed out it wasn't like a cyclical bottom. So now we basically had to this was when Biden was president. Trump's in. He's trying to get oil prices down. He's doing what he needs to do. The Saudis are going to pump more. Regulations are coming off so we can drill everywhere. And I don't really buy into the fact that these oil companies are going to just go out and waste money to get low oil prices. But it can cause opportunities to occur. I'm not at a point where I'd be buying these quite yet, because if we get economic weakness on top of kind of what's happening for other reasons and tariffs and credit, all that stuff, we could see these prices get even lower on these stocks. So probably fairly valued here, but not deep cyclical cheap, right? So I wouldn't quite be a buyer yet, but worth keeping an eye on. I still hold my position just because I bought it for the balance. It's still there. If we do magically get an energy price spike, I don't know how it would happen. I'd probably have to do with Iran or something like that. Would be the only way, but at this point with Trump. But now I would be looking for those deep bottoms. Like, probably not going to get COVID deep, but maybe, down here in the 20, below 20 is totally possible. Then things start getting interesting. Okay. Energy transfer. I don't do any of these like MLP, limited partnership type stuff. They're too complicated for me, too many risks. I don't fully understand all the risks, and so it's hard for me to buy them. And so these were really popular back here. Again, the dividend investors. Whoops, let's do this one. They really liked it, even in here. Let's see if I can get a yield here. So 9% yields, right? That was really attracting people all through this period, really. Even here, interest rates were at 0 and it was yielding like 3%. But if you bought this, let's say before the last recession, which is like 15 years ago, you could have got a 6% return a year with 3% inflation. So let's call it 3 to 4% real return over long term. Just not very interesting to me when you can have these huge drawdowns. 1, 2, 3 during this time period, gigantic drawdowns. Just not a very good risk reward, and I wouldn't buy for the dividend. I don't know what the dividend yield is now, 7%, but we can see right here that it was cut before, right? So just not a good long. I'm not interested in it. Let's put it that way. HROW, what do these guys do? Oh, pharmaceuticals. So Jim liked this one. Now, granted, small pharmaceutical businesses are not my thing. The market, it looks like they're going to start making some money, and the market thinks they will. But what's the market cap? Yeah, not even $1 billion. So these are just too risky for me. I usually want pharma companies to have at least 3 products, on the market or close to it. Every 3 years or something, I'll buy a smaller one if everything looks pretty good. The last one I bought got bought out within like 3 months, and we made a lot of money. But I kind of need everything to kind of come together for me. They don't lend themselves well to the historical kind of patterns that I usually use to help me pick stocks. But so for me, that's like just in the too hard category. Pfizer, I made a video where we bought this one, I think on this dip back in, maybe it was 2023 even. Might have been down here. I sold it after it. This was the selling point. So after the election, and I saw RFK Jr. was coming in, I got out, and it looks like so far a good decision. It's just too many headwinds. It's not only, and I have a video on it if you want to go search for it. If we have, the public just is not in the mood for getting vaccines, and that's part of these guys' business. And then you have lowering drug costs is a big deal for the administration. It's just too hard to predict, and I can find better opportunities in this kind of market. It doesn't mean there's going to be some point where there's a bottom, but we still have 3 more years at least of the current kind of policy folks that are not really in Pfizer's camp. So, I might change my mind later, but the risk reward just doesn't look like it for me. So Kinsdale, and Jim liked Pfizer, by the way. He also likes Kinsdale. For me, these guys are specialty insurance. There's not enough. I like insurance companies to have a long history so I can see what happens when claims actually come in. You can write policies and grow your business and make things look really good. I'm not saying that's what these guys are doing, but this is what can happen. You can grow your business really fast when you're collecting people's money, but then when you start having to pay it out, these can drop off really big time for an insurance company. So I like to have a longer history. I do think this business looks really interesting. It looks like management's really good, but I'm just generally pretty cautious when it comes to that. And I'd probably be more inclined to buy after something bad happens, right? And we get to see how bad it is. The market won't like it. The stock will sell. And then you can assess, okay, how bad really is it? And that's kind of my approach with these. Another insurance company, let's see. I think it's Manulife. Don't know if I can get the right ticker or not. There we go. It's Canadian. I was trying to type in what do you know? Here is a good example. Okay. So I don't look at these ahead of time usually, and I didn't look at this one. So again, we have health and life insurance, Canadian company. Lately, it's been rocketing, maybe because of interest rates. I don't know. It depends on how the insurance company is structured, whether higher interest rates benefit them or not. Usually it's the case that they do, but not always. But here's what I'm talking about. Let's go back to 2008. In that period, we have 26% growth, 6%, 11%. If you went back before this, it was probably pretty good growth. PE ratio wasn't crazy even at the peak, 15, 16 times. Everything looks great. Then what happens? Well, you get a bunch of claims or whatever, disasters, whatever they're insuring, or maybe even the investments that they're making get creamed. And so this is exactly what I was talking about. So that was just convenient. And then you get a bottom here where it's like, okay, finally the worst, but it takes 1, 2, 3, 4 years for that to all shake out. And now you can assess, okay, well, they got through this. Maybe they learned a lesson or whatever. Now, I wouldn't buy an insurance company where I saw this happened in the past, even if they changed, because I'm not going to go do the work trying to figure, because I don't know what risk they're taking. That's the problem. The people that were buying up here didn't know. Maybe the insurance company didn't know. But if you do buy coming out of something like that, maybe you see earnings finally recovered and you bought here for the next go around, you could be up a couple 100% with a solid double-digit return. So it's not that you never want to buy an insurance company or anything, but I think after the disaster happens and the market overreacts, you can see they're going to survive and potentially learn from that lesson. That's when I want to buy. So not before bad things happen. You don't know when they're going to happen. I mean, that's the problem. All right. Iron Mountain, REIT. This one's always kind of gone in the too hard category for me. I have a REIT strategy. This is one of the, when I did back testing, this is one of the didn't fit in it. Like it just didn't work. So I don't track it. I put it in the too hard category. Jim thought it was not a buy. I want to say he liked Kinsdale instead or something, which is probably garbage too. I shouldn't say that. Maybe that was the one. Was that the one we just looked at? Okay. No, it was Kimco. It was Kimco. Sorry. Kimco, yeah. So no thanks on that, right? So he didn't like Iron Mountain. He liked this better. I don't like either one of them. And like I said, 99% of REITs are avoids right now. It's just not a good environment for them. They usually, you don't want to get in a situation like this, right? So before 2008, how are we doing here? Down 60%, 15 years later, you know? And even during the, you know, when everybody was going after dividends and REITs, I'll just like 2015, right in this period, you can kind of see it. You know, since then you have a return that's less than inflation. That's with dividends, right? Without dividends, you're down 50%. So now, granted, I did avoid this one coming off the bottom, and I thought about, and because I thought it was just, the market was just kind of crazy. I thought there was a lot more risk than the market decided not to price in, but it's really leveled. Like that bump happened, and you know, it hasn't really done anything since then. So we'll see what happens longer term, but I'm not really interested in REITs that are just kind of going sideways or down. Okay, that wraps up all 13. Let me know what you think in the comments section. I do take requests and I do individual analysis on those that are longer than just this quick take version. Put those tickers up on the board. I'm behind on comments. I have a bunch of them I need to go through today. But if you found this useful, like and comment. I have a Patreon with weekly picks for $25 a month. I have a free tier on Patreon where I'm going to post some of these videos. And so check that out as well. And I'll see everybody later.